Everyone is wondering, what is the housing market going to do next? With mortgage rates and tariffs and policy changes, there's a lot going on that could really change the housing market going into 2026. And the results might not be what we expect. If you are thinking of buying or selling or even just kind of waiting on the sidelines to see what happens, I'm going to give you all of the information that you need to make the right decisions. Let's start by looking at what the real estate market is doing right now in San Diego. The current median price for a home in San Diego is $890,000, and that's pretty much flat from last year. If we look at just townhouses and condos, that price goes down to $671,500, which is actually up 3.3% from this time last year. Which does make sense if you think about it, because as prices and interest rates have gone up, people are being forced to look at lower price options. So instead of buying a 3-bedroom, 2-bath house, maybe they buy a 3-bedroom townhouse or condo instead. And as the demand for those things increase, so do prices. Meanwhile, if you look at the single family homes, the median price there is $1 million, and that's actually down 2.4% from this time last year. So you can see the higher priced homes, less demand, prices go down. If we look at the inventory of homes on the market right now, there are about 6,000 homes on the market currently. This is down 6.7% from this time last year. But what's more interesting is that from pre-pandemic levels, it's down a lot. So we're at like 6,000 now. We used to be at like 10 to 11,000 pre-pandemic. So we are way down from there. And then we're also down from last year, which means fewer options for buyers. If we look at just single family homes, that inventory is down over 50% from pre-pandemic levels, which really just goes to show that single family homes, things have gotten so expensive that a lot of the people who own those, they can't afford to buy a bigger one. So they're just staying put rather than ever putting it on the market. Months of supply is one of the most important factors in real estate, and something we all look at. Let's do a reminder of what exactly months of supply is. This is, if we take those 6,000 homes that are on the market now, and we divide that by how many homes sold in the last month, you'll get how many months it would sell for how many months it would take for the 6,000 homes to sell. If you are in the 4-month to 6-month range, that's considered like a balanced market. Anything below 4 months is considered a seller's market. Anything above 6 months is considered a buyer's market. We are at 3 months right now. So we're still technically in a seller's market, but the market is acting more mixed. So I would say we're getting pretty close to that balanced market. There are some homes that are flying off the shelves still, and there's others that are just sitting forever or even not selling. Which takes us to days on market. How many days does it take for a home to sell? Currently, that number is, the median is 22 days, which is up 37.5% from last year. That's a huge increase. So gone are the days of homes listing on a Friday and being in escrow on Tuesday. Now they're sitting. It's taking a little while longer. Sellers are going to have to be a lot more patient. Buyers, on the other hand, have some flexibility. They don't have to run out and see the house the second it hits the market. They don't have to make a decision in 5 minutes. They actually have some breathing room. They have some time to decide. They have some time to maybe go back and see it a second time. And then if you look at what prices are doing, I like to look at what percentage of the original list price is the sales price. And right now that's at 98%. That's the lowest it's been since December 2022. So that means there are some potentially good deals to be had if you are a buyer right now, because you might not have to pay a list price. You might be able to get to go a little below that. Unfortunately, if you're a seller, it means you have to be really realistic with your pricing and maybe change your expectations about what you're gonna get. Next, let's look at mortgage rates, because that's the question everybody has. Are rates finally going to come down? Well, the good news is that rates actually already came down a bunch. They're currently around 6.3, 6.4%, somewhere in that range, but they were at 7% not too long ago. So they've come down a lot. Some of that was driven by the most recent Fed funds rate cut, which was just a couple weeks ago and was about 0.25%. But mortgage rates are not actually tied to the Fed funds rate. In fact, they're actually tied to the bond market, but the bond market is influenced by the things that the Fed uses to make decisions about whether or not they're going to cut the rate. So There can be correlation, but they're not tied. In fact, we've seen times when mortgage rates actually moved in the opposite direction of the Fed funds rate. We had an example just last September when the Fed cut the rate by 0.5%, and while mortgage rates dipped a little right after that, over the next 3 months, they went up from 6% to 7%. That being said, the experts are predicting 2 more Fed rate cuts this year, and the hope is that those will bring rates down a little. But when I say a little, I mean a little. Gone are the days of 3% interest rates. Don't wait for that. Not going to happen again unless something really, really horrible happens again. In fact, we're going to be lucky to see rates go down into the 5s by the end of next year. Fannie Mae just predicted that rates will be at 5.9% by December of 2026. And while every 1% change in the mortgage rate increases your buying power by 10%, we're not going to see that big of a shift anytime soon. So it's really not worth waiting for interest rates to go down in order to buy a home. If you're wanting to buy a home and you're ready to buy a home, just do it when you're ready. And if you are going to be selling in the next year, the good news is that with interest rates having come down already some, we should see demand pick up. And that means going into 2026, it should be a slightly stronger seller's market. But here's the part no one really wants to talk about. The second big driver, other than mortgage rates, for what's going to happen with the housing market going into 2026 is tariffs and policy changes. Tariffs on things like lumber, steel, appliances, and other building materials is going to be driving up construction costs. Meanwhile, immigration policy is wiping out a lot of the people who actually do the construction work, leaving only people who are going to be more expensive, which will also drive up construction costs. And when it costs more to build a home, builders pass that on to the buyer. So the price of the house is going to be higher. And this doesn't just impact new homes. This is going to ripple into renovations and flips and even the existing stock of homes. Because if with costs going up, fewer new homes are being built, that means we are not increasing supply, which means prices will continue to increase even if demand stays lower than usual. The good news is that San Diego and California as a whole are working really hard to build new homes. The bad news is that a lot of that focus is on apartments and condos and things that are like near transit stations and employment centers because they need to do density. And land is way too expensive in San Diego to build affordable single-family homes. So if you are looking for a new affordable single-family home, you're going to have to go to Riverside County or San Bernardino County or somewhere inland to find that. And because of this, expect the price of single-family homes to keep going up. So what does all this mean heading into 2026? First off, we nearly always see a dip in prices at the end of a year. Right now, with interest rates also being lower, could be a really good time to get a deal if you are ready to buy now. Going into 2026, however, the best case scenario is that rates slowly ease, supply improves, and we finally do actually get to that balanced market where buyers have some more breathing room, but sellers are still getting fair prices. This is what I'm really hoping happens because it will hopefully also mean that it won't be as slow of a year as this past year has, which has been really miserable for anyone who's been trying to sell a home. But because it's balanced, we still won't be heading into the craziness of 2021, 2022. If inventory starts rising again next year, that will give buyers more options and it will help keep prices from rising too fast if rates do actually go down. The worst case is that inflation sticks around or gets worse, tariffs drive up costs, and affordability gets worse. This means fewer people buying, more people renting, and prices flattening or even dipping in some neighborhoods. And here's the key. Regardless of the scenario, it won't be the same everywhere. Coastal luxury markets like La Jolla and Rancho Santa Fe may hold their values because demand never really goes away in those markets and because real estate is a really good hedge against inflation. So we might actually see rich people investing in real estate, but other neighborhoods could see a dip in prices because of decreased affordability. If the best case happens, we'll likely see small price increases just about everywhere, with higher prices in the March to June timeframe and the lowest prices from October to January. So what should you do? For buyers, don't just wait for interest rates to drop. Use the leverage that you have now to get a deal. Ask sellers for credits on closing costs or an interest rate buy down. In times like this, you can actually save thousands of actual dollars in your pocket now, and you don't have to compete with 20 other people. Sellers will actually pay for repairs. You might get credits. There's a lot of value in buying when the market is slower like this, instead of trying to time it with interest rates, because I promise you, if rates do go down further, demand is going to kick off and you're going to have more competition. And when you have more competition, you lose leverage and it's going to cost you more money, even if prices aren't going up. People get so wrapped up in prices that they forget that there are so many other ways to save money in a real estate transaction. If you can get a seller to help pay your closing costs, that can save you thousands of dollars in your pocket right now. But if you get, say, a $10,000 reduction in price, that saves you like $50 a month. Big whoop. If you can get a seller to pay for an interest rate buy down so that you can get a 5.5% interest rate instead of a 6.5% interest rate, for example, you will save hundreds of dollars a month. And you can get the equity now rather than waiting for the interest rate to drop to that in a year or 2 years and miss out on all that equity right now. If you are thinking of selling, pricing realistically is more important than ever. Homes that are priced right are still moving. Overpriced homes, though, they're sitting. And if you're thinking about relocating and you want to move to San Diego because the lifestyle is just fantastic, don't try to time the market, time your life. Move when it makes sense for you. There are always opportunities to be had, especially if you are flexible with what neighborhoods you end up in. And if you're curious which neighborhoods are holding their value versus which ones may be a target-rich environment to get a deal, I will be breaking that down in my video next week where I talk about which zip codes are going up and which zip codes are going down. So be sure to subscribe and turn on notifications so you don't miss that video when I put it out next week.